as you can see here on your to-do page.
And so the basic overview of shop financials.
Maximize your deductions for charitable contributions.
Hi, this is Kelly from Carmella's with the Tax Tip Tuesday.
What does an accountant do? Because it's not just taxes.
The first thing that I want to do is I want to give you the general overview of a profit or loss, or P&L, and what it should look like. So easy enough. We got sales. Sales are on our top line. Next thing we have cost of goods sold. And so for this example, my cost of goods sold is going to include tech labor, obviously parts, and then also service advisor. And when I'm looking at the cost of tech labor and the cost of service advisor, when I'm talking about this, and in the example that I show, those are going to be loaded amounts, which means that it's not just going to be the tech wages in there, it's also going to be the insurance, payroll taxes, anything else that goes along with the benefits for the employees. There's other stuff going to be in here, sublet cost of goods sold, shop supplies, anything that you're directly selling to a customer is going to be included in cost of goods sold. If we take the sales less cost of goods sold, we get gross profit. And then when we go down a little bit further here, after our gross profit, we use those gross profit dollars to pay for our expenses. And then hopefully we got money left over here at the end. And that is our profit, or in a bad case, that is our loss. The formula that I'm looking for is the following. I always look at stuff as percentages because it's scalable. So the general automotive shop, your gross profit percentage should be around 50%. Then we are going to allocate another 30% for expenses, which should leave us 20% net income. The example that I'm going to do here is actually a real shop's number. Just need some help getting these financials cleaned up. This is what the financials look like before I did anything. What we're looking for here is we're looking for 50% gross profit. You can see down here, we don't have any percentages set up, but this is at about 48% gross profit. That's not too bad. And now if we go down here to our fixed expenses, you will see 55% fixed expenses, right? We got a ton of overhead here, and he's not making any money here. So there's a little negative here, but this is actually a $43,000 loss. What the heck is this? We got this monstrous account called Ask My Accountant that now flips us from a $43,000 loss to a $24,000 net income. Now, if you're looking at these financials, you're probably just as confused as I am. We start seeing that we got some really weird stuff going on. We have cost of goods sold up here. We don't know. Anyone that is using these financials right now and try to make a decision off of it, you're just using a best guess. There's no way that you could fully understand what's going on with this business and what you need to do to change it, given the current setup that's going on. And so this is all out of QuickBooks. This is all collapsed. The general idea here is if you go down through this expanded profit and loss, all of the stuff that we need is in here. It just needs to be set up in a more condensed and streamlined manner. All I did here was I simply just kind of cleaned up the chart of accounts. You can see down below here in our fixed expenses, we got everything streamlined. We put some better detail on some of this stuff. We didn't make $24,000. We lost $41,000. If we would have gone off our profit and loss statement that we had before there, it looked weird, it looked out of whack, but it actually showed that we were making money. When in reality, this was completely wrong, and we actually lost $40,000 on the year. Right off the bat, we know that we lost money, right? So we know we need to look at these financials. It's really not as bad as it looks. Let's kind of go back to what I was talking about before to do a preliminary look at this. We're supposed to be at 20% net income. We are not there right now. We're at 8% loss. So let's work our way up. We're at 46% fixed expenses, meaning that 46% of our sales are going to our fixed expenses. If you remember on my exercise before, fixed expenses should be about 30% of sales. So fixed expenses for an automotive repair shop, they are what they are. There's really not a whole lot that you're going to be able to do to change these things. If you go down through and look at what we're really spending a decent amount of our money on, there's only a handful of things. We got advertising, right? Advertising is almost 2%. Credit card fees. We got office expense. We got officer payroll, pay and benefit groups, our rent, and then maybe the last one here we'll talk about is the shop floor expense. The first thing that comes to most people's mind is I need to start cutting the expenses. I've never seen anyone be able to save their way into a profit. If I start cutting those expenses, what's going to happen to me on the back end? I start cutting my advertising. Hey, in the short term, sure, I'm saving money. I'm not paying my advertisers, but what's that going to do to car count? Is car count going to dry up and actually magnify this problem? It doesn't completely change the landscape. What we're trying to do here is we're trying to drive our sales and drive our gross profit so that these fixed expenses become relatively less expensive. At the end of the day, a shop is really made or broken by two things: parts and labor. If you do parts and labor well, if you have a good gross profit margin on parts and labor, you can pretty much screw up just about everything else and you'll still have a very good business. On the flip side of things, if you don't do parts and labor well, you could have really cheap overhead, you could have all the other stars align, and you're still not going to have a very good business. Our gross profit is 37%. And so I know that we have a gross profit issue. What I'm trying to show you is how to analyze where the issue is and seeing what really the pain point is for a shop.